Welcome to the Deep Dives. Today, we're peeling back the layers on something incredibly important to all of us, our money, specifically the financial services industry.
Yeah, and some pretty blunt critiques are coming from inside the house, you could say.
Right. You've got heavy hitters like Jeremy Grantham saying things like, our economy has a painfully overdeveloped financial sector.
Or the client world pays up precisely in proportion to how bamboozled it is by unnecessary complexity.
Even The Economist magazine has weighed in pretty strongly. These aren't just, whispers. They feel like serious indictments.
And they're not really isolated comments either. A lot of experts are suggesting that, on balance, a big chunk of the financial system might actually subtract value from society.
Subtract value? How?
Well, particularly with active investment management, the argument is it often costs way more than any value it actually delivers.
So the big question we're tackling today is, are these critics exaggerating? Or does the financial services industry, especially, the part dealing with investments and advice, have some serious systemic problems we need to understand?
That's the mission. We want to really dig into these claims.
Cut through the jargon, maybe,
Yeah.
and give you the insights you need to navigate this whole complex world. We're focusing specifically on the investment and advice side today.
Right, not corporate finance. Our sources actually tend to praise that side for creating value.
Okay, so let's dive in. We're going to look at where the incentives really lie, what
Sure.
you're actually paying for, and most importantly, how you can protect your own money.
So when you go looking for financial advice, what's the, number one thing you need? Trust, probably.
Absolutely. You have to trust that your advisor is putting your interests first. Always.
But that's where it gets tricky, isn't it?
It really does. And this brings us to a really crucial distinction. It's the difference between a fiduciary standard and a suitability standard. Okay, I've heard those terms. Fiduciary means they have to put you first.
Exactly. Legally, ethically, your interests come before theirs. No ifs, ands, or buts.
So why wouldn't everyone operate under that standard?
Well, that's the interesting part. The financial advisory industry has pretty consistently fought against making the fiduciary standard universal. They often prefer the, let's say, much weaker suitability standard.
Suitability. Okay, that sounds reasonable. What does it actually mean, in practice?
It just means the product they recommend has to be, suitable for you. Not necessarily the best option or the fairest priced or even, frankly, a good product.
Wait, really? So it could be kind of mediocre or even bad as long as it's technically suitable?
Pretty much. The advisor just needs to show that someone in your general situation could reasonably buy something similar. It doesn't have to be optimal for you. This creates a huge opening for advisors to recommend things that benefit them more than you.
Ah, okay. So that leads to the next question. What is in the advisor's best interest? You mentioned commissions earlier.
Yes, commissions are a huge factor according to our sources. Think about it like this. Maybe an advisor gets, say, $50 for selling you simple term life insurance.
Okay, pretty straightforward product.
Right. But maybe they get $500 for selling a traditional cash value life policy.
More complex, higher commission?
And then maybe there's an equity-linked cash value policy, even more complex, that nets them, $1,500.
Wow. So the incentive is clearly skewed towards the more expensive, complex product.
Exactly. Even if that simple term insurance, the $50 commission one, is actually what's best for most people in that situation, the incentive structure pushes them elsewhere.
It's kind of shocking when you lay it out like that.
It is. And if you think about it in another context, imagine a government official choosing a contractor. If we found out they got a $10,000 commission or kickback from the company they chose,
We'd be outraged. People would call for them to be fired, maybe even prosecuted. You wouldn't buy the excuse, oh, it was just a commission.
precisely. Yet in large parts of finance, these varying commissions based on what product gets sold, it's just a standard practice.
So the purpose, if not to steer clients towards products that make the firm richer, what else could it be?
That's the unanswered question, isn't it? It really makes you wonder how you can get truly unbiased advice under those conditions.
Yeah, how can you trust the advice when the advisor gets paid more depending on what you choose? It seems almost impossible. That's something you really need to think about when dealing with advisors. Okay, so conflicted advice is one major issue. But what about the actual value you get for the fees? Are we paying for something worthwhile?
That's the next big piece. Our sources point out how often clients just sort of blindly follow their advisors. They assume good work is being done because the advisor seems confident,
Right, the appearance of expertise.
Exactly. And this can lead to some pretty surprising situations. There's an example of someone talking to a potential advisor. The advisor says, "My fee is 1.5% times your portfolio value each year." Their portfolio was actually $1 million, so that 1.5% fee wasn't $1,500.
That was $15,000 per year.
$15,000. And it begs the question, $15,000 for what? What specific measurable value is being added to justify that ongoing cost?
That fee becomes even more stark when you look at how investment performance gets reported. Jack Bogle, the Vanguard founder, did a famous analysis on this.
Oh, yeah, the time-weighted versus dollar-weighted returns. It's critical to understand this.
Explain that. What's the difference?
Okay, so the industry usually reports time-weighted returns. This basically measures how the investment itself performed, regardless of when you put money in or took it out.
So it ignores my personal timing.
Completely. Let's say you invest $100,000 and it goes up 20%. Great. Then you get excited and invest another $500,000 right before the market tanks and falls 20%. The time-weighted return might only show a small loss, maybe 4%, because it averages the periods. But your actual personal return, the dollar-weighted return, which accounts for the fact you had much more money in during the downturn,
would be way worse, like maybe down 15% or something.
Exactly. It reflects your actual experience. And Bogle's analysis, looking at data from, I think, 1996 to 2005, it was stunning.
Get this. The industry reported average time-weighted returns of about 40.4% over that period.
This is pretty good.
Yeah. But the client's actual average dollar-weighted return
was just 0.1%.
0.1%. That's barely breaking even. The gap is massive.
It's a chasm, and it raises serious questions. The industry might say, well, we don't control when clients invest.
But their marketing does, right? Pushing the hot funds after they've already gone up.
Precisely. Their advertising campaigns often encourage that exact behavior, buy high, then maybe panic and sell low. It suggests that maybe the focus is less on investing and more on, well, selling.
Marketing. Turning investors into marketers, as one source put it. Okay, so let's talk about beating the market. That's the big promise of active management, isn't it? Picking the winners.
That's the allure, definitely. Finding those stocks or funds that will outperform the overall market average.
But what does the actual evidence say? After decades of research.
Well, the conclusion is pretty overwhelming and, frankly, quite simple. Active management. Trying to beat the market. It's generally no better than chance before you even account for fees.
It's like flipping a coin.
Basically. And then after you subtract the typically higher fees of active management, it consistently underperforms the market index.
Consistently underperforms. That's a strong statement.
It's backed by mountains of data. Our sources give some great examples, like one study looked at consultants whose only job was helping big institutions pick winning active managers.
Okay, these are supposed to be the experts picking the expert managers.
Right. And they found that among the 10 biggest, most well-known consulting firms, 100% of them reported that the managers they recommended performed right around the 50th percentile.
Average. Random chance again.
Exactly. As one critic famously said, you could have saved millions in consulting fees and just given darts to monkeys to throw for similar results.
Wow. Okay, what about tools for individual investors, like Morningstar ratings? Those 5-star funds are better, right?
Well, Morningstar is good at identifying the really bad funds, the 1-star ones. They do tend to underperform.
Okay, so avoid those.
Definitely. But here's the catch. There's generally no statistically significant difference in future performance between the 2, 3, 4, or even the highly coveted 5-star funds.
So the 5 stars don't predict future success?
Not reliably, no. Those stars mainly reflect recent strong performance. It tells you where the fund has been, not where it's going. It's like driving using only the rearview mirror.
So putting it all together, if the professionals, the consultants, struggle to pick consistent winners,
what chance does a part-time, untrained retail investor really have? The odds are stacked against them.
It seems like this consistent failure of active management is incredibly well documented.
Probably one of the most thoroughly documented yet most consistently ignored findings in all of finance. It's quite remarkable.
Okay, so if the products are often overpriced, the advice conflicted, the performance lacking, why doesn't the market just fix this? Why don't these inferior products just vanish?
That's a great question, and it touches on, well, maybe a darker aspect of how this market works. See, highly functioning competitive markets usually assume everyone has roughly equal information and power.
But that's not the case in finance.
Often not, especially for retail investors. The industry gains a massive advantage by selling things that are deliberately complex and using pretty aggressive sales tactics.
The hard sell.
Right. Investors are often made to feel, stupid if they don't understand. So they might buy a truly terrible product just because they're too embarrassed to admit they're confused.
And you can't easily compare these complex things side by side.
Exactly. How do you compare two incredibly complicated insurance policies or structured notes? There's often no practical way, which kills real competition.
Our sources had some examples of this, like the vanishing premiums thing.
Oh, yeah, the universal life insurance sold back in the late 70s and 80s. The pitch was seductive: pay premiums for a while, and eventually the high interest rates credited inside the policy would make the earnings cover the costs, and your premiums would just vanish.
Sounds great. Too good to be true.
Absolutely. It only worked if interest rates stayed sky high, which of course they didn't. When rates fell,
Premiums didn't vanish.
worse. They often had to increase substantially just to keep the policy from lapsing. Sales reps glossed over that possibility, implying the vanishing part was a sure thing.
Were there consequences?
Lots of lawsuits, yes. But incredibly, variations of that overly optimistic projection downplaying the risks are still sometimes used today.
Wow. But the story that really stood out, the one that kind of makes your blood boil, involved taking advantage of someone's grandmother.
Yeah, that was a tough one. An elderly woman in tears because some annuity transactions her advisor recommended resulted in thousands of dollars in unexpected taxes she couldn't afford.
And the advisor's response.
He initially blamed his company's back office, but our sources suspected it was classic churning, just doing transactions to generate commissions, regardless of the client's best interest.
Did the company make it right?
Not at first. They pulled out the fine print. Tax implications are the client's responsibility.
Even though the advisor likely made claims about taxes when selling it.
Right. That's the hypocrisy. Advisors make tax claims all the time during the sales pitch. The only reason the company eventually paid her back was because the advisor actually admitted his mistake, which rarely happens.
So that case really illustrates the problem.
It paints a stark picture, yeah. An industry sometimes structured to exploit complexity and information asymmetry, selling overpriced, poorly designed products that you can't easily compare, often pushed by professionals with skewed incentives. The retail investor is often just outgunned.
Okay, this sounds pretty dire, but we don't want to leave people feeling hopeless. What can you do? How can listeners protect themselves?
Right, that's the crucial part. And the good news is our sources offer very concrete steps. It boils down to asking the right questions, really probing.
Okay, what are the key areas?
There are three main things to investigate.
Company incentives.
Oh.
Ask directly. Is this company owned by stockholders or is it earned by its customers?
Why does that matter?
Customer-owned firms, think Vanguard. Their incentives tend to be better aligned with yours. They don't have external shareholders demanding maximum profit. It's not foolproof, but it's a good sign.
Okay, company ownership, what's second?
Second, salesperson incentives. And our sources say this is potentially the single most important question. You need to ask for and get in writing complete details on how that person is compensated for everything they might recommend to you.
Every single product.
Yes. If they get paid differently, a higher commission, a bonus, anything for selling product A versus product B.
That's a red flag.
Huge red flag. Our sources are blunt. If their compensation changes based on what you buy, just walk away. Find someone else. Their advice simply cannot be considered unbiased.
Wow, okay. So that's a clear line. What's the third area?
Third, product complexity. The rule here is simple. If you don't fully truly understand it after they explain it, avoid it. Don't ever feel pressured or embarrassed.
And ask specific questions.
Very specific, detailed questions. And demand the answers in writing. Like, what happens if I change my mind in 5 years? What are the surrender charges? What are the tax consequences?
Right.
Exactly. If it's linked to the market, show me in writing what my account value would likely be under different actual historical 10-year periods. Good ones, bad ones, flat ones. And compare that directly to a simple, low-cost index fund portfolio after all fees. If it's universal life, what happens to my premium or the policy's health if the interest rate credited drops by 1% or 2%? It stays there for years. Show me the numbers.
So you really have to become your own investigator. Think through all the what-ifs.
Exactly. You need to anticipate future scenarios and demand specific documented answers on how the product performs. especially compared to the simple, low-cost alternative.
And the prediction from our sources is, once you do this,
You'll almost certainly find yourself gravitating towards low-cost, broadly diversified index mutual funds, or ETFs. And for insurance, probably the simplest products, like level term life.
which is exactly what people like Warren Buffett and Jack Bogle have been recommending for decades.
Precisely. For most retail investors, the evidence overwhelmingly points towards passive investing through index funds or ETFs. They give you marked returns, fees are incredibly low, results are consistently good relative to active funds over time, and it saves you a world of complexity and worry.
There's some debate about passive investing taking over the market, right?
There is, on an academic level.
Mm-hmm.
But our sources are pretty clear that we are nowhere near that being a real problem for market efficiency. For you, the individual investor, passive indexing remains an incredibly sensible, effective, and frankly empowering strategy.
Okay, so let's wrap this up. After this deep dive, what's the big picture for our listeners?
Well, I think it's clear the financial services industry, especially the investment and advice side, has some structural issues. Conflicts of interest are common. Products can be overly complex, maybe deliberately so. Performance doesn't always match the fees charged.
It can feel like a minefield.
It can. But the fundamental takeaway is this. Don't just assume you're getting value because you're paying a lot. It's your money. It's your future security.
Don't be intimidated.
Absolutely not. Don't let anyone make you feel stupid or pressure you into handing over your money if you're not 100% comfortable and clear on what you're getting, why you're getting it, and what it costs.
And here's maybe a final thought to leave you with. Sometimes an advisor might subtly, or not so subtly, make you feel unsophisticated for choosing a simple, low-cost indexed approach, like you're missing out on some secret sauce.
Yeah, they might imply it's too basic, not tailored enough.
But the irony is, as our sources stress, and as history shows, those simple index investors, they very often end up being the smartest ones in the room over the long haul.
It's an approach that, unlike so many complex commission products, virtually no one looks back on 20 years later with regret. Simplicity, low cost, transparency.
Those are your best tools. Complexity rarely serves the client. Take control. Ask the tough questions. Your financial future depends on it.